everyone, we'll get started here. So tonight we'll have a very quick market update, and then we'll have Larry Li that's going to present on CMHC commercial financing. So market update, it's been a hot market. May's not been really any different than the previous months. In fact, year over year, we're still trending significantly lower inventory, lower days on market. Prices are up, right? As you see, that's the benchmark sales price of all property type combined, residential. Those are up 9.5% year over year. Month over month, roughly 1% on average between property types. It's still trending month over month as well, not just year over year. And months of inventory, in this case, it's gone up a little bit. We've seen new listings in the past few weeks, especially this week, actually, there's been a few new listings, more than usual for the past few years. But it's getting absorbed really quickly. So we're not seeing price drops. Days on market, again, are still really low. So yeah, 1.1 month of inventory is extremely low. A balanced market's usually 4 to 5 months. So it's up by a tad. A detached side, year over year, we've seen a higher price increase with a benchmark price of over $760,000, 13% year over year. Month over month, a little bit more. I think it's just over 2%. And days on market, like 18 days is not like, most properties are selling within a few days, right? Because don't forget that the 18 days on market or whatever days on market is on there, that's the time from when the property is listed to when the property is marked as sold. And that includes condition period. That also includes deposit in the case of an unconditional offer. So 18 days, like just over 2 weeks, right? A lot of condition period are weak. So very fast market still. Semi-detached, this doesn't even tell the whole story, because if you're looking for semi-detached that has a basement suite, the inventory numbers are even lower. And Santosh and I see it right now. It's really difficult to find those. There's almost nothing available. And again, up like 13% year over year. So it's a hot market out there. Do you have any other comments on?
No, yeah. I mean, at any given point, there's only, you can count with your fingers how many semi-detached there are with basement suites. And then out of those, you have to further filter them for our clients, and we usually end up with zero that are suitable. So. Townhouses,
those are even hotter, especially 3-bedroom townhouses. They've become the new kind of family affordable option. Anyone that was in the past considering a semi-detached or detached that's now been priced out a little bit is looking for, especially 3-bedroom, right? They can still have enough space for the kids, can have a bit of a yard. So those are up almost 20%. So it's actually the highest price increase of any property type we've seen year over year. And again, there's not a ton on the market, and most of them are going over list, especially the ones that are not new build, the resale, like 0.79 months of inventory. It's really fast moving. And condos, same thing. Now the condos did take longer to start to go up. That's one thing to note. They're doing really good right now, but they lagged a little bit behind in the recovery. But they perform really well as well. So that's what all we have for market update. Larry will come over. I think you'll get a lot of value from him on the CMHC financing. It's a strategy that we're seeing used a lot, especially, I'd say, over the last years, probably ramped up even more. So yeah, hand it over to Larry.
So hello, everyone. My name is Larry. I work as a mortgage underwriter for a company called Canada ICI. And today I'm going to be talking about CMHC financing, specifically for multifamily properties. So just very similar disclaimer, this presentation is for educational purposes only. I'm not here to solicit clients, and you should seek financial advice if you guys are doing your own deals. A second disclaimer that's a little bit more relevant to this presentation is that I am not an employee of CMHC, and the company I work for, we're not subsidiaries of CMHC. CMHC is like an independent company that's owned by the government. So I'm going to provide accurate information from my experience, but policies do change, and by the time that you guys do your own deals, certain things can change. So just something to be aware of. So just a quick introduction about myself. Again, I'm a senior mortgage underwriter at Canada ICI. Canada ICI is a national commercial mortgage financing company. We've got about 8 offices across Canada, and we only do commercial mortgages. So what I mean by commercial is things like office, retail, industrial, occasionally land, hotels, and of course, multifamily. Canada ICI is both a broker and a lender. So I work in the brokerage space, so I have the access to multiple sources of capital. But our lending department, we also are very competitive. So if you do decide to work with us, we can get you a quote for any deal that you're looking at. Personally, I've underwritten over $1 billion worth of commercial real estate deals, and I've funded over $400 million just within the past 12 months, most of which has been CMHC insured. So I'll talk more about that in the presentation. And then finally, I'm also an active investor. And within my family and my partner, we have a small portfolio of long-term and short-term rentals. So I guess the topic is on CMHC financing, but before I get to there, I just want to introduce a little bit about multifamily financing in the first place, just because it's a little bit different than, I guess, like residential mortgages. The first thing is, like, when I talk about multifamily, what I mean is any building that has 5 or more units. And as soon as you have a building with that many units, it's considered commercial financing. There are ways to buy a building like this with residential mortgage, but most of the time it's going to classify as commercial. One of the major differences in commercial financing is they don't look at your personal net worth, or sorry, they don't look at your personal income. So usually when you get a residential mortgage, you have to report like your T4 income and all the other things. Instead, a lender is going to look at the cash flow of the building, as well as something called the debt service coverage ratio. The calculation is shown on the slide there, but it's basically the ability for the building to carry debt. So the higher the rental revenue in the building, the more debt it can carry. And so that's what the SCR is. Again, instead of personal income, lenders will look at something called personal net worth. So this is, again, a little bit different. And the reason they look at net worth instead of income is because they want to see whether you have any collateral that you can offer when you get a loan. So if you ever have to default on it, they want to see that you have other assets that they can collect on, and that's pretty much it. And just one last thing before I move on, the process is significantly longer for a commercial mortgage. I would say, for a residential mortgage, you're probably looking around like 2 weeks, 3 weeks maybe to get a mortgage done. With commercial, you're probably looking at 4 to 8 weeks. Today, it's near the higher end of that. So, and it's a lot more expensive, and I'll kind of touch on the fees as we go on. So CMHC stands for Canada Mortgage and Housing Corporation, and it is a company that's owned by the government of Canada that provides mortgage loan insurance. So what that means is, let's give an example. I'm the borrower and I decide to get a loan. If I end up getting that loan insured by CMHC, what would happen is if I ever defaulted on that loan, CMHC would make sure that the lender doesn't suffer from any damages. So it's insurance for lenders. So why would I want my loan to be insured by CMHC? For this is mostly for multifamily, but in the multifamily space, if you get a CMHC insured loan, you actually have access to much lower interest rates, longer amortizations, and significantly reduced debt service requirements. And all three of these factors allow you to get more leverage. So in many cases, you can go up to 95% leverage on a multifamily building, which is, I guess, pretty good. In exchange, the borrower has to pay a premium. So this is similar to any type of insurance that you pay. You pay a premium up front, and then you have to abide to their requirements. And in exchange, they insure your loan. So this slide just talks a little bit about some differences between a conventional multifamily mortgage and a CMHC insured multifamily mortgage. When I say conventional, what I mean is a mortgage that you might get from an institutional bank like TD, CIBC, one of the big five. With the conventional deals, you're usually looking at around 75% loan to value. This is pretty standard. There aren't many lenders that will go higher than that. But if that loan is insured by CMHC, lenders will go up to 95% of value or 95% of cost, depending on the type of project that you're doing. The interest rate for a conventional deal is a spread above the 5-year Government of Canada rate. The interest rate for a CMHC insured deal is a spread above what's known as a Canada mortgage bond. And there's some nuances on how they're calculated, but all in for, I guess, like a typical deal, you're probably looking at around 5.5 for a conventional deal and 4.5 for a CMHC insured deal. So that's a difference of 1%, which can make a pretty significant impact on your cash flow. The amortization on a conventional deal is also usually limited to 30 years. And this is it's actually very rare to see a 30-year deal in the commercial space. Most of the time it's 25 years. But with CMHC insured multifamily deals, you can go up to 50 years as long as your building supports it. Debt service coverage ratio, the requirement for a conventional deal is 1.25, and the requirement is 1.1 for CMHC insured. And just I guess a quick example of how that works is, say you've got a loan that has a $100,000 principal and interest payment every year. For the conventional deal, that for you to be able to qualify for that deal, your building needs to generate at least 25% more income than that 100,000. So it needs to generate an operating income of 125,000. In the case for CMHC insured, that requirement's reduced to 10%. So, if you had the same level of income for a building, what that 10% means is that you can qualify for a bigger loan amount or reduced payments. And then finally, the last row, again, I was mentioning for a conventional deal, you're looking at 4 to 8 weeks. If you want it to be insured by CMHC, you're actually looking at close to 4 to 5 months to get the deal through from beginning to end. So it is a very long time period. So CMHC, they actually offer quite a number of products. They can do retirement housing, supportive housing, student housing, what we call SRO, which is similar to hotels. But the two that we see most often are the standard rental housing and the MLI Select products. And those are for multifamily residential. And CMHC will offer all of these products for construction deals, purchase deals, and refinance deals. The one that I'm going to be talking the most about is MLI Select. And the reason for that is because MLI Select allows you to get up to 95% loan to value and 50-year amortization. How the MLI Select program works is that it targets properties that have specific social or environmental outcomes. So those outcomes are affordability, accessibility, or energy efficiency. And you can see on the table on the right, this is a table for new construction. It's a little bit different for properties that are already existing, but basically you have 3 categories: the affordability, energy efficiency, and accessibility. And there are ways to get points under each of those categories. The goal is to get at least 50 points. If you can get 50 points, then you at least qualify for 95% financing, but you won't qualify for 50-year AM. The 50-year AM is once you can get 100 points through all of these parameters. And just a little bit of a description on each of the parameters. Affordability means that a certain number of the units in your property has to be rented at a level that's below CMHC's, requirement. It varies city by city, but in Calgary, that number is 1737. So if you have units where the rent is below 1737, you can consider it as an affordable unit. For energy efficiency, what that means is if you were to build a new building or do any type of renovation in the future, you have to ensure that the improvements that you're making to that building will allow it to perform in a more energy efficient way than the Alberta Building Code by a certain percentage. So to get 100 points in energy efficiency, you would have to be 40% above code. And then accessibility is similar to energy efficiency, except that instead of looking to add improvements to energy efficiency, you're looking to add things like elevators, ramps, bathroom handles, things that make the building a little bit more accessible. Borrowers are awarded based on a points-based system. The more points you get, the higher the amortization, and also the lower the lower the insurance premium that you pay to CMHC. So what this means is they're pretty much incentivizing you to achieve 100 points on any of these social outcomes. And a minimum of 50 points required and a maximum of 100. So you can go beyond 100, but there's almost no reason financially to go beyond 100 because it does cost a lot of money to add energy efficiency and accessibility. And affordability there's a lot of rules around the affordability criterion. It's not only that you have to rent it below a certain amount, but you're also restricted on how much you can increase the rents by on a yearly basis. So it's similar to a form of rent control on the building. So to be eligible for the MLI Select product, borrowers have to be able to substantiate a net worth of 25% of the loan amount. So for example, if you were getting a $1 million loan, you have to make sure that you can prove $250,000 worth of net worth. And that net worth can come from, the equity that you have in your properties. It could be RSPs or other investments. Pretty much anything that you can substantiate that's legal, we can probably use as substantiation of net worth. Borrowers also need to have suitable experience in real estate. This is a little bit subjective. They pretty much just don't want you to do something that's significantly out of your comfort zone. So for example, if you have only ever done like single family homes in the past, and then all of a sudden you're buying a 200 unit multifamily and you wanted to run it yourself, you might have a hard time getting that approved unless you have a pretty strong team with you. So usually they want to see at least 5 years of property management experience on similar scale properties. And it is very similar to if you're doing a construction project. If you're doing a construction project, they want you or somebody in your team to have done something similar before, or at least have the ability to manage either the contractor or the subtrades. The borrowers also must be willing to provide a guarantee of up to 100% of the loan amount. So this is basically just providing collateral for if you ever default on the loan. And the reason I write 100%, up to 100% is because it does vary depending on the type of deal you're looking at. For construction, they want 100% guarantee until the construction is finished. Whereas if you had a building that was stabilized, that had good rental income, and pretty much all the numbers make sense, the guarantee could be as low as 0. So it really just depends on the deal. The amortization cannot exceed the remaining economic life of the property. So this is another big thing. Basically, if you are looking to get a 50-year amortization loan, but your building is on its last legs, it was built in like the 1800s or something, it might be pretty difficult to get that approved. If you are in a circumstance like that, like you would have to show either that you are going to do some kind of renovation or some kind of like structural performance that will increase the economic life of the building. And usually how this is determined is an appraiser, a commercial appraiser is going to calculate that economic life just based on like a site inspection. And the last thing, this is something that's always been the case, but it's becoming more and more of an issue with CMHC, which is that if you ever want to apply for CMHC loan insurance, you now have to go through a CMHC approved lending partner. Basically, these are just people who CMHC have already trained to run through that process. They don't want people who don't really know how to, make the application, do the applications, just to make sure that the process is smooth. So this is the eligibility. So the next few slides I'm going to talk about are just a few examples. I'm going to go over these relatively quickly. Hopefully we'll have a lot more time for Q&A at the end. But this first example is how you can use CMHC for an acquisition. In this case, this is a good buddy of mine. He was actually able to negotiate a pretty good arrangement with a builder in Calgary. So this building is in Sage Hill in Northwest Calgary. And how it worked was that the builder was going to build this building with their own costs out of pocket and then sell it directly to our client, who is going to buy it with CMHC financing. This building in particular was an 8-plex townhouse, which is 4 upper units and 4 basement suites. In order to qualify for MLI Select, we set 2 of the basement units as affordable. And if you recall what I said earlier, the affordability limit in Calgary is $1,737. Market rents for basement units in that area aren't even $1,700. So it was a no-brainer to set a few of the basement units as affordable. Setting 2 of these allowed us to get 100 points with CMHC, which we were able to get 95% of purchase price and 50-year amortization. Just to provide some quick numbers. I think this deal was about 2.8 million for the 8 units, brand new construction. And the borrower that we ended up getting financing for, he only needed to put down about $140,000 to purchase his property, plus the associated costs to be able to close on this transaction. So that's just one example. A second example is probably something that you're seeing a lot of in Calgary right now. A lot of builders and developers are developing these fourplexes with CMHC construction financing. So this is, again, 4 units at the top and 4 basement suites. And in our case, this building is actually in Forest Lawn, so the market rents are even lower. But we designated 2 of the basement suites as affordable. And then we were able to get them 94% loan-to-cost construction financing and 50-year amortization. I won't go into too much detail about how construction financing works, but basically there's always a requirement of how much money you need to put into the project before a lender is going to give you that construction draw. And in our case, when you get a 94% financing loan, that requirement is very low. So a lot of builders are able to do, I guess, multiple projects at the same time because it isn't a huge impact on their liquidity to be able to do this. And the third example is just something with refinance. So this is an older property on Center Street in Calgary. Our client in this case, he purchased a building, I think, probably 2 years ago for about 1.5 million. So it was underperforming and he got it at a pretty substantial discount. At the time, most of the rents were extremely low, and over a period of a year to a year and a half, he did very light renovations, turned over all the units, and got it stabilized to market rents. In our case, he then came to us to get the MLI Select refinancing. To be able to get 100 points with an older building, we have to designate 80% of the units as affordable, which is a little bit unfortunate, but in our case, it still worked out. And we were able to get this building appraised for, I think, around 2.6 million. And then we ended up getting a loan for him for about 2.3 million. So he was able to take that loan, pay off his initial bridge mortgage, and also pull out an additional $750,000 worth of cash to be used in a future deal. So it's, because you're able to get such high leverage, it is very useful to be able to pull out a lot of equity in your properties and use it for future real estate. I just want to talk a little bit about the timeline, just because it is, like I mentioned, it can take up to 5 months to get through this. And I just want to, this timeline just goes through the reasons why. So usually on week 1, we have an initial consultation with the borrower. So the borrower would send their broker like a list of items, details on the property, things like that. The broker would then prepare an application on the client's behalf. So they would figure out how much loan they think they can qualify for. What the amortization would be. They would give them a list of all the things that they need to get done before the application. And this process usually takes about 2 weeks. So that takes us to week 4. On week 4, the broker would then submit the application to CMHC. Currently, the wait time to get this approved is about 6 weeks. So this is where a huge portion of this timeline comes from. So 6 weeks would take us from week 4 to week 10, and you would get a CMHC approval that we call a certificate of insurance. With that certificate of insurance, pretty much on week 11, we start taking that to different lenders. Basically, you know, we go to multiple banks and we see like, hey, are you interested in this deal? No, are you interested in this deal? And we get a number of bids on this property. The timeline to get this done is usually about a month from the receipt of the approval. Hopefully by that month, the end of that month, the borrower will have a commitment from one of the lenders. And basically what a commitment is it's just an agreement from a lender saying that they are committed to the deal, that if everything goes through, they will fund this loan. And once the borrower signs that, week 16 is the start of funding, which the funding process takes an additional 30 to 60 days. And basically the funding process consists of getting the legal work in place, the insurance in place. There's a number of other things. They want to make sure that the equity that you have, that you're putting into the deal, is coming from like legal sources. So there's some anti-money laundering processes and stuff going on. So if you're on a good timeline, I think week 20, so about 4 to 5 months, you can close on a CMHC insured deal. This is just my final slide. I did want to talk a little bit about the risks and just some things to be aware of when it comes to CMHC financing. The first is, this is something I talked about at the very first slide. The fees that you have in commercial financing are all for the account of the borrower. And these fees are usually surprisingly high. If you've never done a multifamily deal, I think you'll be caught off guard with how much these will be. To give you some examples, legals, you actually have to pay for both your lawyer and the lender's lawyer, and that ends up being around $15,000. Environmental will be about $4,000. Appraisal will be around $4,000. Lender fees are usually up to 1% of the loan amount. So for $1 million loan, you're looking at another 10 grand. Broker fees are, that kind of depends, but probably another 10 grand. Title insurance is 4 grand. So all in, you could be another 50K into the deal, which is something really to be aware of if you've never done a commercial deal before. The other thing is that the interest rate is actually not fixed until a few days before closing. So the process is a little bit different. You don't get pre-qualified with CMHC on a certain rate or anything. Basically, we do the underwriting at a specific rate and we submit it to CMHC. But as you're aware, like the process is 5 months. And so interest rates could change quite a lot. And if at the time that you're actually funding this deal, the rate is different, there can be issues, especially if the rate is higher. If the rate is higher than what we applied with, what you actually have to do as a borrower is you have to put more money in to buy down the rate. This is something worth mentioning. It can be very difficult to find a lender for smaller loans. I guess a caveat here is like we'll definitely be able to find a lender for you, but it can be very challenging, especially when you're dealing with loans that are around the $1 million mark. Actually, just anything less than $2.5 million can be very difficult to find with a lender. And the reason for that is because it's about the same amount of work for them to fund a $2 million loan than a $20 million loan. And the amount of fees that they collect on a $20 million loan is usually 5 to 10 times higher. So they would prefer to do bigger loans if possible. Again, the timeline is currently about 5 months from application to funding. So something to be aware of, not only is the interest rate changing during that time, but you can also have other things change, like your rental income can change, vacancies can change. When COVID happened, expenses changed very quickly as well. Construction costs, lumber went through the roof. So there are many things that could change during this financing window that you should be aware of. And then finally, just a last note, there always is a little bit of a risk with leverage. And do you really need 95% financing? The story here is it's, in most cases, like, you're probably okay, especially if you structure your deal correctly. And the reason for that is because for real estate, if the market value ever goes down, you can always hold for the longer term and wait for the prices to go back up. The problem with leverage is that if the prices go down and you are forced to sell, then that becomes an issue. Because when you're 95% financed and you're forced to sell in the down market, many times the sales price won't even cover the loan. And so if you want to exit out of that property, you might actually have to put more money in at closing to be able to pay off the loan. So that's just something worth mentioning with regards to leverage. And then also 50-year amortization. 50-year am is quite significant. If you recall, amortization is pretty much the number of years it takes to pay down a loan. In residential, you're usually capped at 30 years. With the 50-year amortization, what ends up happening is like the first 10 years, you pretty much pay down no principal because of how long the amortization is. And so that's just something to consider. You know, a lot of people, they actually prefer having principal pay down just because when you refinance that money out, it's a tax-free source of cash. Whereas with a 50-year amortization, you're usually able to get higher cash flows, but cash flows are taxed a little bit differently than refinance proceeds. So that's pretty much it. And that's the end of my presentation. Thank you. Opening the floor for questions.
Do you have a list of the lenders approved by CMHC?
Yeah, so there's quite a number of CMHC approved lenders. You can find it actually on the website. But the ones who actually like do deals in multifamily and who are pretty frequent, there's probably only like 14 of them. And a lot of them are in Ontario as well. Like they don't do Alberta deals. And similarly, like some of the credit unions in Alberta, they don't do Ontario deals. So in the end of the day, you're probably just looking at like the big 5 banks. So TD would do it, National Bank, RBC would do it. In Calgary specifically, Service and Connect First, they're good sources for CMHC. ATB would be another one. And there's some other ones, but depends on your deal. Like if you're doing a construction deal, like some lenders won't do construction deals, whereas other lenders, they have like certain requirements. So trying to think of an example, like National Bank, for example, in Ontario, they won't do a construction deal that's below $5 million. That was what it was a couple of months ago. It might have changed, but it just kind of depends on your deal and your circumstance, which lender
So
we
your
go.
favorite lender is Canada ICI.
Yeah, Canada ICI. Yeah. The company I work with, we're also a lender.
So it's an important distinction.
It is an
I
important
don't
distinction.
think
Yeah.
Many people get so as a regular mortgage broker, I have to go to CMHC and submit for this program. It's actually challenging working, and you kind of want, like the idea is that you actually want to get your approval first, then you can shop it around. Well, most mortgage brokers can't go to a commercial lender, get an approval from them, and then shop it around unless they never want to do business with that lender ever again.
Yeah.
That's the model that Larry's company has, though, because they're the lender, so they're okay doing it because they're kind of doing it to themselves. So he can underwrite as a lender, and then use that to shop around. So it's a pretty distinct advantage that he has, but also because it's almost all you do all day long is this program. So you're pretty, you know what you're doing.
Yeah.
But it is a distinction between you being both a lender and a broker at the same time.
And from the realtor's perspective, what Lane is saying is like, it's a pretty big deal actually, for sure, right? To be able to do that, it's a big distinction. It's very different in the commercial side from residential in that way.
Yeah, it is a slightly different, or I guess massively different. Yeah.
It's
Do they
pretty
still
big
have
difference,
a two-person or a 2 loan limit per person guaranteed?
No.
No. Okay. The other one is.
So you said 2 loans?
Like let's say I guarantee an MLI Select product.
Yeah.
Can I do 3? Because I know you couldn't for a while.
Yeah, you could do it now. Yeah.
Okay, you can still guarantee more than 2.
Yeah.
Okay.
Yeah. It's mostly based on your net worth.
Yeah.
So if they accumulate, add up all of the loans that you have at
Right, you do an
CMHC,
aggregate of,
and then 25% of that, exactly.
makes
As long as
sense.
your net worth is surpassed that, you're good.
Okay, and then the other question I had is, so let's say you do this program and you have a building. When you go to sell the building, you can refinance out of it. Obviously, pay the loan off with a penalty, I assume. Or even if you just own it, you could refinance out. And how would if you were to go to sell this building, how would the covenant transfer to a new owner? I know you've dealt with less of that given the timeline the program's been available, but.
Yeah, so when you are, I guess in this case, let's say you're buying a CMHC insured building and the seller has this type of mortgage already in place and is selling it to you, and he doesn't want to break his mortgage for whatever reason. What you would have to do is you would have to assume that existing mortgage, close on the property, and then what we would do is we would do what's called a transfer of covenant, which is a thing with CMHC. It's a pretty simple process where we replace their guarantee with the new guarantee. But there are some caveats to that, which is that they want the guarantee to be similar sized. So if the seller had, let's say, $1 billion worth of net worth.
Okay, so the covenant.
Yeah, the covenant has to be similar. Yeah,
risk.
yeah, exactly. So
not just that you meet the parameters of the program, you have to match the seller.
Yeah. So the requirement is actually sometimes higher than 25% of the loan amount, and it can be a little bit tricky.
And then the covenant, so if you're assuming the mortgage, you're also assuming the 10-year commitment as well as
That's
all
right.
of those other things.
That's
so
right.
if you're buying and using
That's
the
right.
program.
Even if you break the loan, you still have to maintain that 10-year
Oh,
commitment.
sorry, that is.
Yeah.
So even if somebody wanted to pay off, like buy the loan, buy the property cash, the building still has to.
Yeah, it still has to be affordable for 10 years.
So when you're selling this in 5 years, let's say it's now 50% loan to value just because of the market, you've got to sell it to somebody that's buying it. They're
still have
gonna
to.
have to.
But that's the hard part, right? Because
You don't know what it's going to look like. You don't know now what it's going to look like. So it could be a negative selling it down the road because you might be renting far, far below market
Correct.
while still wanting to get top dollar for it. So
That's correct.
Could they buy it with conventional mortgage?
can't even buy cash. It would still stay with the building.
If you get
the
a,
covenant stays.
regardless of how you buy it, if you have affordability on it, it stays for the 10 years.
That's good to know.
Yeah.
Yeah.
And do those affordability levels increase as the market increases? Or
So you're allowed to increase your rent based on, I guess, your province's inflation index for housing. So in Alberta, it's been pretty good because
So inflation or affordability?
inflation.
Okay.
So the housing inflation was like 10% year over year. So people who did this last year, they can raise their rents by 10%, which is a pretty massive boost. But you're capped at that inflation number. So
And the affordability is
Sorry.
set at
Yeah.
30%.
So you're saying inflation. So inflation wasn't 10%. You mean housing?
like the housing part of
Housing.
inflation.
Okay.
Yeah,
gotcha,
yeah,
okay.
yeah. For Alberta.
Yeah, gotcha.
Yeah.
I thought it was CPI.
CPI, yes. CPI index, inflation. Yeah.
I just had a question about, you mentioned the timeline is about 5 months for an approval round.
Yeah.
So if you're doing a construction job mortgage and you're 25% of the way through and then you need to take a draw, how long does it take to get the draw once you actually go through you or CMHC to get that draw?
It would,
Is that a long drawn out process too?
so the 5 months, so getting the COI from CMHC takes about 2 to 3 months. And then the remaining months is to get to funding. So that 5 months would be the time to get to your first draw. Does that make
So
sense?
that's the first draw. So what about
Yeah.
the subsequent draws after that once you've all been approved?
Subsequent draws will be, so lenders are different. Some lenders will have like a minimum draw amount. So you can't draw if it's like less than 100K per draw, right? So usually some borrowers, they would do it on a monthly basis, and those are much quicker because the second draw, all subsequent draws, doesn't have to go through CMHC anymore. It's only the first one that needs to get approved by CMHC, and then the last one that needs to get approved by CMHC.
Right, so the middle ones are all just approved by the bank and
Yeah.
they send out an
Correct.
appraiser to take some pictures and
It wouldn't be, so it would be your QS, your quantity surveyor. You would have to get them to survey your project. And you would also need your architect to review your project to make sure that it's being built in accordance to their drawings.
so is there a cost to those two things too?
There is a cost. Yeah.
Approximately how much?
To get quantity surveying done, it's probably an additional $25,000. I would say for an architect to review do progress reviews, it's probably an additional $500 per visit that they do to your property.
Okay, so it sounds like the QS is
Yeah.
charged up front and then they just go.
So it's charged incrementally. It costs about $4,000 to put out the initial report to do the first draw. And then every single draw afterwards, it's about $2,000 for the QS to do the reporting and to do their site inspection.
Okay.
So just over time, it adds to about $25,000 for
Thank you.
a typical project. Yeah. Go ahead.
Let's say you're buying property like this with your partner.
Mhm.
How would the net worth assessment go?
So you're buying a property with a partner? Is that what you're saying? They would just look at both of your net worths.
So would it be
Yeah.
like an average or just combined?
It would be combined. It also depends who's providing the guarantee. Because if you're buying a property and both of you guys are willing to provide a guarantee, then they'll combine your net worths. But if, for example, you wanted to just be the general partner and then your partner wanted to be the limited partner and you didn't want them to have a guarantee, then it would just be on you. Yeah, so it depends how you structure it. Yeah.
You said they need an experienced individual applying. What do they require for experience? Like, does a CV suffice, or how do they?
Like as the borrower or as like a contractor, or what do you mean?
To qualify for
As
the
a
program.
borrower-
To qualify?
As a borrower doing construction,
Yeah.
the MLI.
So
And so they want somebody that has experience with construction. What do they need to quantify that, and what kind of checks?
So
There's no
you-
credit check for that, right? So
right,
I can say
exactly.
whatever I want.
Yeah.
How do they-
Like if you're using a very reputable builder,
I'm gonna build it.
pardon me?
I'm gonna build it. Which one?
It might be a little bit more difficult to get that approved. Yeah. Like we can certainly try, but again, like you need to be able to show some
Like you have
Demonstration.
You need to have
like warranty is actually not a big deal. It's just like if you've never done, let's say you've never even done a renovation before, and then you were building 100 units. That's a big problem for CMHC. So it kind of depends on the size of projects. Because I know you've done renovations before, right? And I don't know if you've built before. Maybe you have.
Long time ago.
Yeah. So maybe that would qualify as experience. I think, in my opinion, yeah.
Do they check at all? I mean, I've done over a dozen rentals in the past 2.5 years. That's it. They want to walk my properties, or what?
What they will do is what we would do as the broker is we would gather a list of projects that you've worked on and have an idea of like how much it costed you to build this thing, and then we'll just say like, hey, Peter's got done $20 million worth of construction before and has this experience.
They just kind of take your word for it.
Yeah. In the end, it will also be the lender, so the bank will have to verify as well. And the QS will also have to verify all of your sub-trades to make sure they're qualified. So it is a very detailed process to go through.
Does the years of the business count towards that? Like how long this business is in?
Yeah, like there's all of the experience things is all very subjective. I would say even if the builder's only been around for like 2 years, but they've done massive projects, that would still work.
Projects like from units or can be.
It can even be single family homes, yeah. Because a lot of these buildings, like even if you had 5 single family houses all next to each other, you can qualify for multifamily financing. Yeah. Even if they're across the street, you can do it as well. There's a little bit of a nuance when it comes to doing like across the street, but if they're all in a line, you should have no problems. Yeah, go ahead.
For the fixed rates, for how long does it stay fixed on the month to month?
So it would either be a 5-year or a 10-year term for the MLI Select product. There's some other products out there as well with CMHC that have different terms, but it's usually a 5 or 10 year term. Yeah.
You said during construction, CMHC wants you to 100% personally guarantee the construction portion, correct?
That's right.
What happens at the end when the property is built and you're terming it out?
Yeah.
You still need to personally guarantee 100% of the...
You do until it's been stabilized. Once you can show 12 months of consecutive revenue with the building, then your guarantee gets reduced to either 0 or 40%. It will depend on the file. Yeah.
So the personal guarantee could be removed once stabilized.
Yeah.
100%, 40% up to 100%.
Like most of the times it gets removed to 40%, but there are some times where I've seen an underwriter or CMHC drop it all the way down to 0.
And that's after 12 months.
That's after 12 months of stabilized, yeah, EGI, yeah.
And there is reporting every year you have to report.
That's right.
Make sure you qualify and you have your two of your 8 units under rent.
Yeah, so the lender will check the 2 of the 8 units, but yeah, I guess the lender will check for that, and they'll also check that you're not surpassing, or sorry, you're not below your debt service coverage. Yeah, so you need to maintain a 1.1 DSCR.
So what happens if you're in an environment where rents are dropping, like a downtown or something like that? If you go below your debt coverage ratio, are they asking you to fill up for the loan?
I actually don't know how that would happen.
Because
Yeah, it hasn't happened yet for us. Yeah, so
Very little room for error, right?
yeah, that's right. That's
Because
right.
we've seen like 15% rent drop.
But the thing is, like when we do our underwriting with CMHC, what we'll put in like a caretaker cost. We'll put in like a pretty high repair and maintenance cost. There would be like other reserves and things like that. Realistically speaking, those items aren't on your DSCR calculation. Most of the times, like for townhouses, you won't have a caretaker, right? Your repair and maintenance might be very little for the first few years because it's a brand new building and it could be under warranty. So it kind of depends on the project again. Yeah, go ahead.
It's all costs like engineering, surveying,
Yeah.
finance as well.
Yeah. So when we do construction financing, you'll give us a budget that includes includes the land cost, it includes the hard costs, and includes all your soft costs. And then we'll add in a bunch of other things like contingency, interest reserve, and financing fees. And we'll use that we'll use that as the budget. So when CMHC, when you have a loan that's insured by a construction loan that's insured by CMHC, they also have to finance the land, because otherwise there's no way for them to register a mortgage on it if you already have another mortgage on the land. So they want to make sure that they can pay out that existing lender, and that's why the land is part of the budget as well.
Okay.
Yeah.
Include all those fees that you mentioned. I was thinking of.
Yeah. That would include all the fees. Yes. Yes.
On the first draw
Yeah.
of construction, when they take out the land,
Yeah.
Do they get another appraisal to establish what the land value is at that
No.
point?
No.
How do they value that? Is it a purchase price?
Um,
Purchase price could have a building.
So before we submit to CMHC, you'll need to have done an appraisal. And that appraisal will have 2 parts. One is the as-is value of just the land as it is. And the second part is a as-complete value, which is after you've finished building it. And the value that CMHC will use will be that land portion from that appraisal. So it could be much higher than what you bought it for. Let's say you bought it, in 2010 for $300K, right? And now it's appraised for $800K, right? And you automatically have $500K of equity in that land that you can use as part of that down payment for the construction draws.
How does it work out with partners? So if you want to have partners that are not from
Yeah.
the same family, because until now we're talking about one person or a family deal. So if you have multiple partners, at that point, the guarantee that you have, because both partners might be worth different amount of both, right? So at that point, how does it work out?
Everybody's 100% responsible. I think that's the question you're asking. It's like,
Yeah.
if you're on a loan, residential or otherwise, everybody's 100% responsible for the loan.
Yeah.
So they're like, it's like if you could avoid having to, like even a husband and wife when they can buy a rental property with me, if they can afford it in just one of their names, I always suggest that they do it that way, because otherwise they're 200% responsible. Like they're both responsible, and then it makes it also restrictive for future things that they want to do. So, but the real answer is if they ever have to execute on that, they go after the highest net worth person first until they get their money back.
It's usually always, so what he's talking about is a joint and several guarantee, and it's almost always going to be that. So let's say you have a loan amount that you're guaranteeing, it's $1 million, and it's you and your partner, and it's 50-50. If you ever default on the loan, they can go after you for the entire $1 million.
That's fine. What I'm asking about is the initial 25%, because you've got to have your worth 25% of the total loan, right?
Right.
So if two people are worth $1 million.
Yeah, we'll just accumulate it, combine it. Yeah.
Great. I think we'll wrap it up.
Great.
Thanks a lot, Larry, for providing us with good information, CMHC.